With consumer price index in the US staying above the 8% mark, which is uncomfortable to the Fed, it has to affect your investment portfolio. It could obviously take a big hit. It pays a price for high prices in the markets that we consume. And this isn't new. Historically, whenever inflation has risen, equity valuations have ended up bleeding. Since the Second World War, sticky, long-term, persistently high inflation have led to overheating of the US economy. And historically speaking, long-term inflation has led to recession inevitably. So with the Federal Reserve and other central banks scrambling to bring down inflation, interest rate hikes are one of the most potent tools that central banks have to bring down inflation, to control inflation. Rising inflation is generally followed by rising rates. And the stock market investors, they react strongly to changes in key interest rates. So on the 11th of May, when the US Bureau of Labor Statistics announced CPI at 8.6%, the Dow Jones actually fell a little more than 1%. The S&P 500 went down. It went down around 1/3%. Similarly, when you look back on the 10th of June, the consumer price inflation hit 9.1%. As an effect, we saw the effect play out on Wall Street, and there the Dow took a knock of 2.73%. The S&P lost 2.9%, close to 3%, and the loss run continued the next day as well. Also consider the 13th of July, when the US reported some amount of cooling off in inflation. Still, it came in at 8.5%. A fall on Wall Street, of course, is what we saw, but it was certainly more controlled. Both the Dow and the S&P lost less than 1% at that point in time. So if you look at the components of the S&P 500 in the second quarter of this fiscal, they seem to have performed rather well. The companies when you look at the index, the companies that we're talking about have reported a 6.7% earnings growth and a 13.6% revenue growth. But when you look at the index as a whole, year to date, the S&P 500 is up around just 1%. Naturally, it begs the question, why are investors worried about rising rates? Well, rising rates have a direct correlation to how stocks are going to perform. Some stocks, of course, do better, others not so much. Growth stocks in particular, they are sensitive to changes in interest rates. This is because the fund managers of these growth stocks, they use a discounted cash flow model to assign values to these stocks. So with interest rates now rising, fund managers tend to assign lesser value to growth stocks. But having said that, the question comes down to your portfolio. How does the road ahead look for your investments? We really can't say it'll get better anytime soon, because most analysts are expecting the US Fed to continue raising interest rates. Many, on the other hand, believe that inflation may have peaked, but it will likely remain at elevated levels. So the bleak mid-winter that we're talking about may not just be a possibility for Europe, but stock market investors around the world, and that does include India.